Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rocket Lab.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, if I told you a space company just surged, like nearly 230% in the last 12 months.
Which is just a wild number, by the way.
Oh, completely wild. And if I've said they dominate 64% of all U.S. non-SpaceX orbital launches, and they're actively building the laser communication infrastructure for the post-2040 economy, you would probably assume I was talking about Elon Musk.
Right. I mean, everybody's mind defaults straight to SpaceX when they hear those kinds of stats.
Exactly, but I am not. Today, we are looking at what is quietly becoming the second giant of the space economy.
And that is a momentum shift that really forces us to reevaluate the entire sector, you know? For years, the market treated the space economy as this winner-take-all monopoly.
Like, there's only room for one big player.
Yeah, exactly. But seeing a secondary player consolidate this much market share while fundamentally changing how missions are built, it demands a closer look.
So our mission for this conversation is to really tear down the engine driving this massive price momentum. We need to, examine the actual strategic moat they're building, understand the mechanics of their cash pile, and most importantly, answer the really tough question.
Whether a $35 billion valuation is actually justified here.
Right. Is it justified, or is this stock priced for absolute flawless perfection over the next decade?
And that valuation disconnect, that's going to be the central tension of everything we discuss today.
Because, a 230% surge over 12 months does not happen purely on good vibes and cool rocket renderings on Twitter.
Yeah.
We need to know what is actually happening on the balance sheet. And looking at the revenue, this is no longer a speculative startup just drawing blueprints on a whiteboard.
No, not at all.
They are pulling in $554.5 million in annual revenue.
And the composition of that $500 million, that's what separates them from the massive graveyard of failed space startups. They aren't just relying on launching things into the sky. They operate on a model of aggressive vertical integration.
Well, when I hear vertical integration, my mind usually goes straight to consumer tech, right? Like Apple designing their own silicon chips so they control the whole iPhone experience. For a space company, does vertical integration just mean they build the rocket and own the launch pad, or does it go deeper?
Oh, it goes much deeper. It goes all the way into the anatomy of the payloads, the satellites themselves. Because when people visualize a space company, the mind immediately goes to the launch pad, right? The fire, the countdown, the massive Electron rocket-breaking orbit.
Flashy stuff.
Exactly, the highly visible main event. But launching rockets is an inherently lumpy, unpredictable business. You do not launch every single day.
Right. Weather happens.
Weather causes multi-week delays. A 20 sensor anomaly scrubs a mission at the very last second, or, a payload customer just isn't ready in time. So consequently, revenue from launches comes in chaotic chunks.
And Wall Street notoriously despises unpredictable cash flows.
They hate it, which means if you only rely on launch revenue, your stock chart is going to look like an electrocardiogram. So to counter that lumpy launch cadence, they've heavily built out a space systems division.
So this isn't just about the rocket anymore.
No, they are manufacturing the crucial fundamental hardware components that go inside the satellites themselves. We are talking about critical lifeblood components, things like solar panels for orbital power generation, and reaction wheels.
Okay, wait, we should pause on reaction wheels, because I was looking into this, and understanding the mechanics of these components really explains why they command such high profit margins.
Yeah, the physics are fascinating because in the vacuum of space, you can't steer a satellite like an airplane. There's no air for flaps to push against.
Right, so if a satellite needs to turn to face a specific patch of the Earth, or, point its antenna at a ground station, it usually relies on small chemical thrusters.
But the moment a satellite runs out of that chemical propellant,
it becomes a multi-million-dollar piece of space junk. It's completely useless if it can't point its sensors.
Precisely the problem. And reaction wheels solve this by using the physics of angular momentum. Imagine you're sitting on a spinning office chair while holding a heavy, rapidly spinning bicycle wheel.
Okay.
If you tilt that spinning wheel, the physical forces will cause your chair to rotate in the opposite direction. Reaction wheels do exactly this inside the spacecraft. They are ultra-high precision electric motors spinning heavy flywheels.
Oh, wow. So by simply speeding up or slowing down these flywheels using solar power, the satellite can rotate itself endlessly without ever burning a single drop of finite chemical fuel.
Exactly. And building these to operate flawlessly in the extreme radiation and temperature swings of space is just incredibly difficult engineering.
That makes the pickaxe analogy incredibly literal here. You know, during the historical gold rushes, the people who built the most sustainable generational fortunes were rarely the prospectors down in the mud hoping to strike a vein.
It was the guy selling the shovels.
Exactly. The real wealth was captured by the merchants selling the pickaxes, the shovels, the denim. In this modern orbital gold rush, Rocket Lab isn't just mining the gold by launching their own rockets, they're manufacturing the pickaxes.
Yeah, they are selling these reaction wheels, solar panels, and flight software to their direct competitors.
Which is wild.
It is. And the beauty of that pickaxe model is how effectively it hedges their overall operational risk. Think about it. If a competitor's rocket has an anomaly and explodes on the launch pad, the launch provider takes a massive financial hit.
But in that scenario, Rocket Lab still gets paid for the solar panels and reaction wheels that were bolted inside the destroyed satellite.
Right. It provides this steady, high-margin baseline of cash flow that completely insulates them from the inherent volatility of the launch sector.
So let's talk about that cash flow and just the sheer cost of doing business in this sector. Because space is brutally, unforgivingly expensive. I was digging into their financial health, and they have constructed a, frankly, massive war chest.
Oh, yeah. They have a lot of cash right now.
They recently upsized a capital raise, entering into a $1 billion forward equity agreement that leaves them sitting on over $1 billion in cash with zero urgent liquidity concerns. But I see this phrase forward equity agreement thrown around in their filings all the time. Functionally, how does that act as a shield against the dilution death spirals that usually kill space startup investors?
It's actually a brilliant piece of financial engineering. Normally, a capital-intensive company in a massive growth phase has to repeatedly return to the public markets to beg for cash.
Right, they just keep issuing shares.
Exactly. They issue millions of new shares every few quarters just to keep the lights on and fund research. And when you dump that many new shares onto the open market, the value of every existing share drops. That's dilution.
Which crushes retail investors.
Right. But a forward equity agreement fundamentally shifts that dynamic. They pre-negotiated a deal with institutional banks to sell shares at future dates, locking in funding commitments based on specific terms, rather than just haphazardly flooding the market whenever their bank account gets low.
So they basically secured the runway before they actually needed to build the plane. They can aggressively fund the massive capital expenditure needed to bend the metal, build new launch pads, and test engines for their upcoming heavy-lift rockets.
Without compromising their day-to-day operations.
Yeah, or panicking retail investors every 3 months.
It essentially guarantees survival through the development phase. Having $1 billion in cash transforms a company from a vulnerable startup into an actual institutional player. They no longer have to make short-term, compromised engineering decisions just to hit a quarterly earnings target.
Okay, having $1 billion is certainly a flex.
Yeah.
But if we're listening to this and looking at our portfolios, we have to ask how they are actually deploying that capital to lock out the competition. You mentioned earlier that the market treated space as a monopoly.
Yeah, for a long time.
Yet right now, their Electron rocket holds a staggering 64% of all non-SpaceX U.S. orbital launches. That is not just participating in an alternative market, you know. That is dominating it.
The consolidation in the launch market is so stark right now. If a government agency or a commercial client has a payload that needs to reach orbit, and they aren't booking a ride with the biggest player in the industry, the statistical probability is overwhelmingly high that they are calling this company.
But the true defensive moat isn't just their launch cadence, right?
No, it goes back to that unified vertical integration we talked about. They control the full life cycle of a mission, they build the satellite components, they launch the payload, and they even manage the on-orbit operations using their own proprietary spacecraft, the Photon, which acts as a deep space bus.
Shuttling customer satellites to their exact final orbits.
Exactly.
But I want to push back on the depth of this moat for a second. Because space technology evolves violently fast. A monopoly today is often completely obsolete tomorrow. I was looking at their recent regulatory approval in Germany to acquire a company called Mynaric.
Ah, yeah, the laser communications acquisition.
Right. Which, on the surface, sounds incredibly cool. But does acquiring laser tech actually build a high switching cost for a customer? Or is it just a shiny technological add-on to make their portfolio look futuristic to investors?
That is a critical distinction to make, and I can tell you it is definitely not a shiny add-on. It actually represents the backbone of how modern space infrastructure operates. The era of launching one massive solitary satellite is kind of over.
It's all about constellations now, right?
Right, mega constellations. Networks of hundreds or even thousands of smaller satellites blanketing the globe. And for these constellations to provide global broadband or continuous military surveillance, the satellites need to talk to each other instantly.
Because bouncing a signal from a satellite over Europe down to a ground station through underwater fiber optic cables and then back up to a satellite over Asia introduces way too much latency.
Exactly the issue. And they solve this using optical intersatellite links. They're literally firing high-powered lasers at each other across thousands of miles in the vacuum of space.
Which is insane to even picture.
It really is. They're transmitting massive packets of data at the speed of light without ever routing it through Earth. The engineering required to keep two lasers perfectly aligned on targets moving at 17,000 miles per hour is just mind-boggling.
So by acquiring Mynaric, they aren't just buying lasers, they're absorbing the communication layer itself.
Yes, and by integrating that communication layer, they create an ecosystem with astronomical switching costs. Imagine you are a defense agency planning a multi-billion-dollar satellite network. You can go to this one single company to buy the solar panels, the reaction wheels, the laser communication arrays, the launch vehicle, and the on-orbit flight software.
A literal one-stop shop.
Right. And if your entire mission architecture is built on their unified, seamless ecosystem, you cannot simply swap out a vendor down the road to save a few pennies. To change providers, you would have to redesign the physical and digital architecture of your entire network from scratch.
That makes their revenue incredibly sticky.
Unbelievably sticky.
And the stickiness of that ecosystem perfectly explains the recent market reaction to the NASA Ignition Catalyst. Because on March 25, 2026, news broke about NASA's $20 billion Ignition program, which is totally focused on building sustainable moon-based infrastructure. And the stock instantly jumped 10.5% on the headline alone.
The market recognized the logistical reality of what a $20 billion lunar plan entails. Building a permanent presence on the moon requires an unprecedented, continuous pipeline of materials.
Right. We are talking about shuttling habitats, rovers, life support systems, scientific payloads from Earth to lunar orbit week after week after week.
Exactly. And as the undisputed #2 launch provider, armed with deep vertical integration in their own orbital transfer vehicles, they are structurally perfectly positioned to capture a massive slice of those early logistics contracts.
So if you're listening to this and tracking the timeline, you might be scratching your head a bit. We have established that they are printing money with high-margin satellite components. They have $1 billion in the bank to fund expansion. They are dominating the alternative launch market, and they're perfectly positioned for a $20 billion NASA moon base.
It sounds like a perfect setup.
It really does. So why on earth did this stock recently suffer a violent 40% pullback? We need to look at the reality of the chart right now because a 40% drop isn't just a minor correction. That is a severe bleeding of value. Let's dig into the price action and the real risks.
Yeah, we have to step back and look at the broader macroeconomic environment for that. This stock trades as a high beta growth asset.
I want to break down high beta for a second because we hear it a lot in financial media. Trading high beta essentially means this stock is strapped to the broader market, but without any shock absorbers.
Right, it feels every bump.
Yeah. If the tech sector hits a speed bump, a high beta stock feels like a 10-car pileup.
And the reason space stocks inherently have such high beta really comes down to the math of future cash flows. The massive profits this company expects to make are largely projected years into the future, post-2030.
So any wobble in the economy hits them harder.
Exactly. When interest rates fluctuate or the broader market gets skittish about inflation, investors heavily discount those distant future cash flows. We saw it react violently to the recent geopolitical tensions with Iran, which just amplified the broader market's fear. And more specifically, we saw a massive sector rotation.
Right. The narrative abruptly shifted. It was heavily covered by headlines, noting that the Trump 2.0 high flyers were falling back to Earth.
Right. The classic rotation out of speculative, capital-intensive growth and back into safer, traditional value stocks.
And when institutional money rotates out of a sector, a stock that just ran up 230% is like the first thing they sell to lock in profits.
Exactly. A severe consolidation phase, like the 40% pullback we witnessed, is almost structurally necessary to flesh out the short-term speculative money. It establishes a higher, healthier base of long-term investors.
But the volatility isn't solely driven by macro noise and interest rates, is it? It is deeply rooted in what I consider a massive valuation disconnect. We are talking about a $35 billion market cap for a company that has never posted a profitable year since its initial public offering.
That is the immovable core of the bear case. At a $35 billion valuation, the market is completely ignoring what the company's balance sheet looks like today.
So what are they pricing in?
The stock is currently priced for absolute unblemished perfection in 2035, not 2026. That valuation inherently implies that their future development roadmap executes flawlessly without a single major engineering setback or catastrophic failure.
Which naturally brings us to the elephant in the room, execution risk. And for this company, execution risk has a specific name.
The Neutron rocket.
Exactly. The entire bear case centers on the development of this next-generation medium-lift launch vehicle. Historically, in the aerospace industry, on schedule usually means, well, we only delayed the rocket by 2 years instead of 5.
Yeah, timelines are notorious in space.
And Neutron has already experienced significant timeline slips that spooked the market. So if this stock is priced for perfection, what happens to that $35 billion valuation if Neutron fails on the pad?
Well, if Neutron encounters further severe developmental delays, or worse, suffers a catastrophic explosive anomaly during its inaugural test flights, the 230% momentum we've been analyzing will violently fracture.
Just break entirely.
Completely. The fundamental math of their revenue projections dictates this. Here is the critical metric to anchor on. Just 3 successful launches of the new Neutron rocket could equal the revenue generated by an entire year's worth of launches from their current, smaller Electron rocket.
Let that sink in for a second. 3 single launches equal an entire year of their current launch cadence.
The economics are operating on a completely different magnitude. Neutron is designed to lift massive mega constellations and heavy national security payloads that their smaller rocket simply cannot carry.
Right, they need the bigger payload capacity.
And because of that massive payload capacity and the higher price per launch, Neutron is the absolute, undeniable linchpin of their entire financial model. Everything we have discussed today, justifying the valuation, achieving the aggressive growth projections, and expanding their profit margins, it all hinges entirely on the Neutron rocket flying successfully. And flying soon.
Knowing that Neutron is the ultimate make-or-break linchpin, exactly when should we be watching for this to unfold? Like, let's map out the catalyst calendar for the next few quarters so you know what events will actually move the needle.
The absolute focal point for the market is Q1 of 2026. Investors are desperately watching for either the inaugural test launch of Neutron itself, or at the bare minimum, the announcement of a definitive locked-in launch window.
So they need hard dates.
Yeah. If they can deliver concrete confidence in Q1 that the rocket is ready for the pad, the bullish thesis remains entirely intact.
And assuming they survive the Q1 scrutiny, what is the next major hurdle?
We then move into Q2 of 2026, which shifts the focus from engineering milestones to contract flow. We expect potential announcements regarding the NASA ignition logistics and launch contract awards.
So that's the money quarter.
Exactly. That quarter will be the first tangible test of whether they can actually convert NASA's $20 billion vision into legally binding backlog revenue on their balance sheet.
Okay, beyond the concrete NASA contracts, there are also some fascinating speculative elements floating around the aerospace sector right now. There are unconfirmed but highly persistent rumors about their potential involvement in the broader supply chain for the Artemis 2nd lunar mission.
Yeah, that chatter is getting louder.
Right. While there is nothing explicit in the initial program summaries, the tradable excitement surrounding their potential inclusion is definitely building.
And the defense sector represents another massive impending catalyst. They recently secured a $190 million defense contract rating. Speculation is incredibly high that they are positioned to secure additional, highly classified hypersonic and national security work.
Which ties into that new military strategy.
Right. The driving force behind this is a Pentagon doctrine called responsive space.
Yeah, I was reading about this. The military realized that if an adversary blinds or destroys a U.S. spy satellite during a conflict, the Pentagon cannot afford to wait 6 months for a rideshare slot on a massive heavy-lift rocket to replace it. They need rapid response.
The Pentagon needs the capability to pull a rocket out of a hangar, bolt a tactical satellite to the top, and launch it within 24 hours of an order.
Which traditional rockets just can't do.
Exactly. Traditional massive rockets are logistical nightmares to prep on short notice. But Rocket Lab's smaller Electron vehicle is perfectly suited for this agile, rapid deployment model. That unique capability makes them highly attractive for classified defense budgets.
So, synthesizing everything we have unpacked today. The high-margin pickaxe fundamentals, the aggressive $35 billion valuation, the massive unified moat, the severe macro volatility, and the make-or-break neutron catalysts. What is the final score on the board here?
Analyzing the totality of their strategic positioning against the risks, the bullish score comes in at an 8 out of 10.
Wow, an 8.
Yeah. The fundamental moat they have dug is incredibly wide, but it is deeply counterbalanced by a valuation that demands flawless execution on the Neutron program. The overarching investment thesis is an aggressive long-term hold, strictly looking at a 2 to 5 year time horizon.
I think that time horizon is the most crucial takeaway for you to remember today. This is not a short-term quarterly earnings play. You aren't buying this stock hoping to flip it for a quick profit after the next earnings call.
No, definitely not.
This is a high-conviction structural bet on the post-2040 economy.
The core thesis is that this company successfully establishes itself as the critical underlying infrastructure backbone for the next entire era of orbital commercialization and lunar defense budgets.
They aren't merely trying to launch rockets.
No, they are positioning themselves to be the indispensable utility provider for the industrialization of space.
Which represents a profound shift in how we conceptualize the global economy.
Yeah.
We've established how they are manufacturing the basic picks and shovels of orbit, securing the high-speed communications networks with lasers, preparing a new heavy-lift rocket that fundamentally rewrites their revenue math.
Right.
They aren't just participating in the space economy. They are actively attempting to become its foundational logistics network.
And with over $1 billion in cash secured on the balance sheet, they possess the financial runway to actually attempt it without starving to death in the process.
So here's a final thought to leave you with, something to just, mull over as you watch this stock navigate its Q1 catalysts. If this company successfully cements itself as the foundational logistics, power, and communication network for the post-2040 space economy.
Which is their explicit goal.
Right. What terrestrial industries down here might find themselves completely upended? Think about traditional global telecommunications networks, the multi-billion-dollar industry of laying deep-sea fiber optic data cables, or even traditional shipping logistics. How many legacy monopolies on Earth will be rendered totally obsolete by this entirely new infrastructure currently being built in the stars? Keep looking at the bigger picture.